All right, I hope everyone's morning's going well. I'm a little bit late on doing Tracy Shuchart's weekly energy report, but better late than never, right? So, all right, big news from OPEC, and I'm just going to say either OPEC or the Middle Eastern producing countries type thing. It's the same, pretty much the same thing. So on Monday, the Saudi oil minister said that the oil futures disconnect may force OPEC into action. Yesterday, we saw other OPEC nations reiterate this sentiment. Witnessing this recent harmful volatility disturb the basic functions of the market and undermine the stability of oil markets will only strengthen our resolve, he said. Bloomberg asked, this is a good one, are you concerned about the current state of the market, of the energy market, of the oil markets? And the Saudi energy minister said, the paper oil market has fallen into a self-perpetuating vicious cycle of very thin liquidity and extreme volatility, undermining the market's essential function of efficient price discovery, and have made the cost of hedging and managing risk for physical users prohibitive. This is a negative impact on the smooth and efficient operation of oil markets, energy commodities, and other commodities, creating new types of risk and insecurities. This vicious cycle will amplify by the flow of unsubstantiated stories about demand destruction, recurring news about the return of large volumes of supply, and ambiguity and uncertainty about the potential impacts of price caps, embargoes, and sanctions. All right, so what is he saying? Real quick, there's a paper market and a physical market, pretty much for every commodity, right? What are paper markets? Those are basically traders on Wall Street or the like around the country, around the world. Physical markets are exactly what they said, physical markets. So the paper markets do affect the price of the physical markets and vice versa, right? So if you're going to, I don't know if you ever bought gold, but you'll go buy gold and they'll say, oh, hey, it's $17.50 an ounce. Where do they get that number? They get it from online, which is affected by paper trading, right? But if a big bank says, hey, we want to short gold, and they put $1 billion short against it, that is going to tank the gold price, right? But did they add $1 billion worth of gold to the market? Did all of a sudden we find $1 billion more worth of gold? No, they didn't. All they did was they shorted it, thus making the price go down temporarily, type thing, or they sold it, type thing. It's the same thing. And so paper markets have an effect on the physical and the physical vice versa. If all of a sudden we have a shortage of gold, people are going to start buying gold and the price is going to go up, right? So what he's saying here is that a lot of the paper markets are disconnected a bit from the physical markets. And this is creating a big flow because eventually the physical market's always going to catch up, right? You can on paper put as much zeros as you want on a spreadsheet, right? But when that bank account doesn't clear, or that credit card says, hey, your limit is hit, it doesn't matter how much you put on the zeros. Like the actuality of what's going on, the principles, the fundamentals are always going to win out given enough time, especially with something that we use all the time, like oil, right? Gold is a little different type thing. We don't use that on a daily basis. But oil is one of those things that it's in everything. Or as I heard the other day, the only person that can say that they're not using oil is someone on naked on the side of the road with a sign made from paper type thing or something like that. It was pretty funny. Okay, BBG. In your view, how is the current volatility impacting the function of the markets? Right. Actually, let me get back to this other one. So, no, I answered. I'm sorry. So basically, the oil market, the physical is going to catch up. Type thing. The market price is going to catch up with the physical. But right now, when someone says something, it's just going to throw the price up or down, right? So if the Middle East or Russia says, hey, we're putting more on the market, then the price is going to go down, right? Traders are going to be like, oh, sell and more supply. If they say, oh, we're cutting supply, or we have to, or we missed our supply goals, it's going to make the price go up. What he's saying is that these aren't the fundamentals that are being affected. They're just whiffs of whatever news article comes out that are really affecting prices, right? And I like the fact that he said unsubstantiated stories about demand destruction, right? Everybody's like, demand destruction, it's going to happen when we go to an economic downfall. And, to a point it will. It always does if we go into an economic downfall. But to the extent of what everybody's saying, like $30, $40 oil, $50 oil again, no. all the pros are saying, no, that's not going to happen. A lot of them don't think it'll break 80 for very long. I'm in the camp. I like to be ultra conservative, so I don't think it'll break 60 on on the worst of its worst type thing. Recurring news about the return of large volumes of supply and ambiguity and uncertainty about price caps, embargoes, and sanctions. So all this really affects it. I can go into details, but the biggest thing is that he's purposely saying, hey, there's not going to be as bad as demand destruction everyone's saying. There's not going to be a return of large volumes of supply like everyone's going to say. What is that paragraph? That alone saying, it's saying oil's going to be really bullish. Oil's going to go up in the future and it's going to stay high. It is not, we're not going to return to $2 gasoline for a long time. All right, and Prince, okay, so in your view, how is the current volatility impacting the functioning of the markets? This is detrimental because without sufficient liquidity, markets can't reflect the realities of the physical fundamentals in a meaningful way and can give a false sense of security at times when spare capacity is severely limited and the risk of severe disruption remains high. Bam, what I just said, but like so much more highly educated. And I think I'm going to add to this is that the SPR drawdown, the special drawing rights drawdown that our president is doing is doing just this. It is giving a false sense of security at a times when spare capacity is severely limited. And actually, Tracy is going to get into it, so I'm not going to spoil it. Nowadays, one need not look for evidence of this. The paper and physical markets have become increasingly more disconnected. Exactly what I said. In a way, the market's in a state of schizophrenia, and this is creating a type of yo-yo market and sending erroneous signals at the times when greater visibility and clarity and well-functioning markets are needed more than ever to allow market participants to efficiently hedge and manage huge risks and uncertainties they face. Oh, what was that? That's basically what I said. The paper markets and the physical markets are disconnected. The paper markets are saying, hey, oil is going to go down or stay, they're going to be this huge supply and such like that. The physical markets are saying, nope, we don't have enough. And what happens with price when we don't have enough? It's going to go up. And again, at the end of the day, the physical market will win. Just give it enough time. This is another reason I'm hugely bullish on oil right now. And for the next, 3 to 4 years. Maybe 15 depending on what commodities do. Anyway, this after. Okay. All of this was said after the OPEC Plus missed output targets by 2.9 million barrels per day in July. So just to tell you I'll just say 3 million barrels per day does is our president of the U.S. is putting 2 million barrels of oil on the market. And that sunk oil prices down from about 110, 105, and it kind of leveled out about 85, 86, right? So I'm just saying, and that's a lick my thumb, put it in the wind kind of guess, but it took oil down about $20 a barrel, we'll say, right? I don't think that the ratios are the same, if that makes sense. For every 1 million barrels of oil extra on the market equals $10 shortfall. But it gives you a good idea of what happens when things go on the market, right? And the price fluctuations, and also just the fear and all he's been saying about the paper markets and the news, that they can be easily swayed by anything, and that greatly can reduce the prices or it can exacerbate the prices, right? This is basically what it just said. I'm just going to go to her commentary. Technically, the OPEC fully unwound the 10 million BBD cuts they implemented back in 2020 with the last production increase in August, although they still have not been able to reach those targets. This September, we could see them implement some cuts again in order to, at the least, spook the futures markets into reconnecting to the physical markets. I mean, if that's not the ability to manipulate markets, I don't know what is. The physical markets are extremely tight, but the futures markets are facing a lack of interest right now as the SPR special drawing rights releases are starting to weigh in on the front month, along with Russian oil making it to the market. And China still on lockdowns due to zero COVID policy. The Saudis really need Brent above 100 for their budget to cover expenses for their NEOM project in the desert. All right, what is that saying? So what it's saying is we've got three things that are really affecting, well, they're really kind of keeping oil prices corralled for now, right? We got the SPR, the special drawing rights that the president is releasing from our reserves. We've got Russian oil that's hitting the market. What happens is the U.S. put embargoes because of the war, and then what happens is Russia's just selling it, backdooring it to China and to other countries for a reduced price. So instead of paying $100 a barrel, they're saying, hey, we'll cut you, we'll pay it, pay 75 or 80, right? I mean, I as a business person, I'd love that. Like as the Chinese who don't care about the war, they're gonna love that, right? A deal is a deal. And then the last part is China still has a zero COVID policy due to their lockdown. I want you to remember that. Those three things, the special drawing rights, the Russian oil, and China and their zero COVID policy on lockdown, right? Because if they've got the whole or part of the nation locked down because of a zero COVID policy, there's the thought that, hey, they're not going to use much gas, right, or energy. Okay. If they do this, and what she's saying is the Saudis may do cuts to send oil higher because they need for their budgeted $100 on Brent for their new project in the desert. Again, they're building cities where cities aren't built, and so they're having to do. It puts a lot of resources in there, right? When you're building a brand new city in a desert that is, well, deserted, there's nothing there. Gotta put everything in. All right. If they do decide on cuts in the next meeting at the end of this month, it could be bullish fall. Seasonally, we should see a pullback in the oil markets due to natural demand declines. We may see the opposite instead. I am betting we're going to see the opposite instead. More on that in the future. What she's saying is that typically during the summer season, that's where everyone's on vacation, everyone's traveling because, well, in most parts of the world, not in Texas, but in most parts of the world, things are thawed out, right? And so you can travel. And so typically, the summer is where oil and gas gets higher, and then it kind of tickles off and goes down a little bit in the fall and wintertime, and natural gas goes up, okay? We might see the opposite of that. We already have SPR releases ending at the end of October. Falls in line with what you just said. When inventories are taken out of the SPR, they're added into reported commercial crude inventories. Once those draws stop, this means there is less added to commercial crude inventories. Once they start replenishing the SPR, those are taken from the commercial crude inventories. In other words, once those draws stop, there will be fewer barrels available on the market. If and when they start replenishing, will take even more barrels off the commercial market. In addition, the People's Party Congress in China also do around that time that she suspects she will have to open up China before he seeks re-election, quote unquote. Additional cuts from OPEC Plus would tighten an already extremely market. Would tighten an extremely tight market already. Seasonality, we see a pullback in the oil markets due to natural demand declines. We may see the opposite instead. So what she's saying is this. Everything's primed for oil and gas to fly up when it really shouldn't be flying up. It should be kind of curving out and going a bit down, right? We've got the SPR who either they will stop after the elections, or they'll be forced to stop after the elections because they just can't draw anymore, right? There's only a limited amount in their bank account. China will most likely open up because she wants to get reelected, right? And people who are locked down when other countries are not, they typically don't want to reelect you. And reelections in quotes, I think we all understand why, but still, the face of it is really affected. China's big on saving face. Won't get into that, but he wants to look good for the election, so he'll probably open it up and make people happy for a time. And then if OPEC does additional cuts, then that's going to make it make it fly up even higher. My thoughts on this is, I think the fall gas prices will go up, but I don't think they may do a hockey stick. Who knows how far they're going to fly, but 2023 is definitely going to be higher gas prices regardless, because China's not going to stay closed forever, right? The SPR is going to take 2 million barrels. It's been putting 2 million barrels on the market. It's going to take them off now, and it's going to have to refill. So you're thinking of a swing of not just 2 million barrels, of 4 million barrels a day, right? And we just saw gas is going up. It's about $10 from the 3 million that OPEC didn't do. So if we're taking like an extra 4 type thing off, and the OPEC tightens and takes a few million barrels off, we could see a swing of like $20 a barrel again, right? And that's going to go into 2023, and it's going to hit 2023. All right, European power prices still skyrocketing. So I'm going to let you read this, but basically Europe's getting really bad. I'll highlight this. German power costs are now over $1,000 per barrel of oil equivalent. That sucks. That sucks. She goes into why. I'm not going to go into it. Just know this. Germany is really hurting. One of the things I will say is this, is Germany is the powerhouse of the EU, of the Economic European Union, right? They are the huge manufacturing bases. What do you need when you're manufacturing? What do you need when you're building stuff, right? When you're building cars or turbojets or oil drilling bits, what do you need? You need power, right? You need energy to do this. You got to have not just the lights on, but you got to have that machinery going. Well, if they're paying a rear end ton for energy, something's going to break. Either manufacturing is not going to be able to afford it, either manufacturing is going to have to raise their prices, skyrocket it, which is going to send reverberations through everything that we buy and do, or 3, they're just going to shut down and go somewhere else, right? Hey, maybe energy is cheaper in France, right? Who didn't shut down their nuclear plants and all this other stuff, right? So we're going to move our factory there because we can actually afford power. It might be 80% off in comparison to what we have to pay in Germany. All right, and again, Germany is the leader of the Green New Deal. They've been doing it for the last 10 to 15 years, and they're running into problems. I think that's going to happen in America if they keep pushing it. All right, fertilizer. She talks a little about fertilizer. I'm going to let you read this, but basically, the biggest thing is that the current situation in the natural gas market that determines profitability of production is exceptional, fully independent of the company news is not as possible to predict earlier. Basically, what they're saying is that a lot of fertilizer is made from ONG products. Sometimes the natural gas, sometimes the oil and such like that, and so it's going to go up. There is a bit of, it's a pullback, but what is, we'll get into this into other articles. They're not fixing the problems. They're just making them worse. So if there's a pullback, in other words, if a big price decline happens, it's just going to be probably a matter of time before the price shoots back up. It could go back higher than it was. It could back to where it was. But my point is this: is when there's a pullback, when the prices go low, and you don't fix the problem, that means prices are going to go even higher. This chart gets more frightening. Okay, so she jumped into the real quick on fertilizer instead of jumping into the SPR, the US SPR. She gives ticker symbols to watch: MOS, IPI, and CF. I'm gonna jump to a screen right here. Crude oil. So right now it's hovering around 95. Again, like 2 weeks ago it was like 85. This is one of my favorite stocks to follow, to kind of swing crude. If you're big on that, but in 6 months, if you had jumped into it when it bottomed out in July, around middle of July, that was about 110, 115. It's up to 185 right now, and it topped out during the Russian invasion at 253. So it is a double ETF. This is not financial advice. None of this is. I'm just saying this is what I like to do. In the past 6 months, it's up almost 70%. Excuse me, 60%. And it's just going to go higher. This is going to go higher. It may have some pullbacks that happens type thing. If you look at this, see it's pulling back, going up, pulling back, going up. But look at the 5-day. I mean, there's a little bit of a pullback, and then it just keeps going up, pulls back, goes up, pulls back, goes up. I mean, it is set to explode type thing. So I'll let you do some research if you want it. Again, not saying you should do this type thing. I'm just saying this is the one that I like to, and it is up quite a bit. If you got into it, gosh, at like 110, 115, you'd be making a ton of money right now. So, but she gives some stock ideas, right? MOS, which is, they're all U.S. companies that have to do with fertilizer. So I'll let you check those out. What she says is that there's probably a pullback. I don't see that. Okay. Yeah, last week there was a pullback, and eventually it's gonna fly up. So, and it almost just kind of goes with oil. Yeah, July. Yeah, it follows oil. So you can invest in fertilizer, you invest in oil. It seems like it's gonna be on the same wavelength. So anyhow, all right. SPR. This is where it gets really scary. If you're living in the U.S. or maybe perhaps a U.S. citizen. And she starts out. This chart gets more and more frightening. The Strategic Petroleum Reserve (SPR) is a complex of 4 locations that stockpile emergency oil in deep underground storage caverns created in salt domes along Texas and the Gulf Coast, and has a capacity of about 714 million barrels. As of this week, we are stilling at about 453 million barrels in the reserve. So we've taken out about 40% of it, right? We've only got roughly about 60% low. Basically, in 1973, the U.S. created the SPR so that it would never have to depend on foreign energy as a nation again. So basically, when the Saudi oil in the 70s, when the oil crunch came, the leaders of our nation said, "Hey, what if this happens during a time of war? We would be effed. We would be screwed because we can't fuel our jets, our tankers, or our what am I thinking? Our any of our vessels we can't fuel, right? And so we would be screwed in a time of war. All right. Here's the issue, though. The reserve typically holds more sour crude barrels than light, sweet crude barrels. For this reason, the U.S. produces a lot of light, sweet oil, but is very little heavy oil. When light oil is refined, you can only get gasoline and lighter products from these barrels. We need heavier barrels in order to make the heavier distillate products that we need. Jet fuel, fuel oil, heating oil, etc., which is most of what we import from other countries. So yeah, so the U.S., there's a lot of horse trading, really in any industry, but in the oil and gas industry as well. And some of that horse trading is that says, hey, we have an abundance of light sweet crude, and we can't always refine it or refine it all. So what we'll do is we'll sell it to another country. They'll buy it from us and they'll refine it, right? When you refine things, you have to get the mix correct. Okay, so sometimes we'll take a little bit of that dark sludgy crude and mix 10% of that or whatever percentage with light sweet crude, and you get a crude that our I keep wanting to say distilleries, but our not distribution centers. The word is not coming to me, but the places that make the gas that we can drive. I feel dumb, but those I'll call them distribution factor places right now. But those not distilleries. Anyway, but when we refineries, there we go. Thank you. When we refine it, it's very refining is heavily complex. This is why you see like acres of refineries, and they have all these big intelligent people, smart eggheads that have one job in this one sector and stuff like that. But they're heavily complex, is my point, and so they have to get the right measure because that's what all the sensors are calibrated to. That's what everything is, and to redo it would take a ton of work and not really worth it, right? So it's better just to say, hey, we're going to pour the right consistency into it as opposed to redo it every time, right? Redo all the calibrations every time. So we'll horse trade some of our oil for some of their oil and vice versa. What she's saying is that most of what ours that we produce here is good for cars and some other things, right? But it's not really good for wartime. It's not jet fuel. It's not stuff you can put into a tank and everything like that. It's not good like heavy diesel. A lot of times we buy that from overseas. We do have some of it, but not as much as the lighter stuff. So far, the U.S. has mostly drained these heavier barrels, and for the first time, there's more light oil in the reserve than heavy oil in the reserve. This is bad. We're not in an emergency. High gas prices are not an emergency. The emergency will be when we have gas lines and heating outages in areas that depend on heating oil for heat. The SPR should be used in case of a national emergency, not as a piggy bank. Let us hope we never see a crisis happen, but if we do, we have no buffer. Whoa, that was a lot. What she's saying is, hey, it's being taken out for political reasons, right? You just look at it. They started it 6 months ago. It ends in October. What happens in September? The midterm elections. It is just so blatant that they are sucking the reserves. They're sucking the safety of our nation out for the hope of political gain, right? It's not even lowering oil back to like $2 and something a barrel or a gallon. It's still around 3 to 4. And so we've drained the stockpile. If we have an emergency, we're going to be in a very bad situation. And what is everybody thinking? What is going around all the YouTubes and everything else that may happen? A war, right? With Russia or China or both. Russia's already invaded Ukraine. That happened about 6 months ago. What's happening in China? They're firing missiles. They're shooting, I'll say at Taiwan per se, but it's mostly around Taiwan. You know, it's lots of saber rattling. Everybody is saying, hey, we are on the verge of World War III. And what are we doing? We're draining our energy reserves to all-time lows. This is the lowest it's been since '85. This is not a good setup for our country. And this is not, oops, we made a mistake. This is the direct result of the leadership we have in place. All right, from there she talks about BTU, which is a coal energy company. She basically just retraces and says, hey, I was right about the stock. It flew up, $6, which is a good swing, and that's it. So I'll leave you with that. It seems very dark and gloomy, which, yeah, it should, because of what's happening. I don't want to blow sunshine up anybody's rear end. I'm just not that type of person. I'll tell you like it is. You can count on me for that. What we're seeing in the future is the oil and gas prices going up in the fall, which is not normal, but everything's primed for it. And I'm seeing, and everyone that I'm talking to is seeing, that in 2023, oil and gas prices will be even higher than they are today. So buckle up for that, right? And if that, and we may be on the verge of a war. Who knows what's going to happen in the next 12 months, right? And in wartime, what do you think is going to happen to gas? Oh, it's going to fly through the roof. What happened with the Russian war? Right, it went up. Okay, and it was hovering beforehand. It was hovering around, $75-$85 a barrel, give or take. And when the Russian war with Ukraine started, it jumped up eventually at about 120, 125. And then when it came back down, because we found out that Russia's putting oil in the market, the embargoes didn't work, and the president's dumping millions of barrels on the market, right? But here's the thing, it didn't go back down to 75. It's still hovering around, like the lowest it went, I think, was 84, 85 for like a few days. And it's now hovering around $90, $95 a barrel. Yeah, it's at 94, 97, so $95 a barrel. And it's just going to go up. So my point is this, even with a war and all those thoughts about Russian oil embargoes and such like that falling off, and the president putting a ton of millions of barrels onto the market, oil still went up $10 to $20 a barrel. We're going to pay, energy prices are going to be astronomical next year, both in oil and gas. And the question you got to ask yourself is, am I going to feel bad going to the pump? Am I going to hate this? Or am I going to say, oh, this is awesome. I've invested in oil and gas. I invested in mineral rights with James. And I'm going to get paid every time oil goes up. I'm going to get paid even more, right? So as I tell people, you're going to invest in oil one way or the other. You're going to invest in energy one way or the other. You're going to pay at the pump, or you're going to check in your bank account. The choice is yours. Give me contact me today if you're interested. There's some deals that we're looking at that are quite good, and I'll give you more details on them.